Welcome back to the Deep Dive. Today, we are opening the file on Absci Corporation, ticker ABSI, a biotech firm making, well, a pretty audacious claim. They say they can use generative AI to solve one of the biggest problems in pharma, the huge drug failure rate.
It's a massive promise.
Absolutely. So our mission here is to synthesize what our sources tell us about ABSI. It's currently priced around $4.40 a share. This is as of October 29th, 2025. They're promising faster development, cutting down that, 90% failure rate. But the big question is, can they actually pull it off? Or is this just, selling a dream?
Well, this is really the definition of a battleground stock. And that's the immediate hook for you, the listener. The market is just completely polarized here. You got analysts on one hand saying strong buy with targets up above $8. Real optimism there.
Yeah.
But then you look at the short interest. Nearly a quarter of the public float. We're talking 21, maybe 23%. That's serious money betting this thing crashes and burns.
Wow. Okay, so a huge divide.
Exactly. So our job is to try and walk that line, unpack the science, the financials, and figure out why there's such a massive contradiction surrounding Absci right now.
It sounds like a classic high-risk, high-reward situation. Let's start with how they've set up the business to even attempt this. Chapter 1, Business Understanding. So Absci runs this hybrid business model. The sources suggest it's pretty strategic, almost essential given the risks, right?
That's right. It's actually quite smart the way they've structured it. It's designed to get them immediate validation and some cash flow while they fund the big long-term stuff.
Yeah.
So near term, the money comes from collaborations and partnerships, like big names like Merck, AstraZeneca.
Right.
And this provides something really crucial, non-dilutive capital.
Okay, let's break that down a bit. Non-dilutive capital. Why is that such a big deal for a smaller biotech that's, burning through cash?
It's huge because it means you're getting money, upfront payments, milestone payments, maybe royalties down the line without having to issue more stock.
So they get funded and get a stamp of approval from the big players without watering down ownership for existing shareholders.
Exactly. It pays the bills, validates the tech.
Okay, so that covers the near term. What's the long-term prize they're building towards, though?
That's the internal pipeline development. This is where they keep full ownership of the potential blockbusters. Assets like ABS-101 for IBD, inflammatory bowel disease, and ABS-201 for hair loss. Both of those are heading into phase 1 trials. The plan seems to be develop them internally until they hit a key value point like showing effectiveness in humans and then potentially license them out for a much bigger return.
Got it. Let's pivot to the tech itself. The integrated drug creation platform, they call it a technological moat. But what stops a giant like Pfizer from just building their own version? What's the real edge here according to the sources?
Yeah, good question. The moat isn't just the AI design part, though that's important. They use generative AI to design new antibodies, basically from scratch.
Yeah.
In silico just means on a computer. They're aiming for targets that were previously considered, undruggable.
Okay.
But the real secret sauce, the differentiator, seems to be their synthetic biology data engine. This is the wet lab side.
The physical lab component.
Right. They use these custom-engineered E. coli bacteria. It's a high-throughput setup, screening billions of different antibody variants every single week. And this lab-in-the-loop system feeds back into the AI. It generates a truly mind-boggling amount of proprietary data. We're talking nearly 3 trillion new data points weekly.
3 trillion weekly. That number just sticks with you.
It really does. And that sheer scale of unique proprietary data is what they claim gives them an edge over AI models trained on, say, public data sets, which can be messy or lower quality. And this fuels their main pitch, speed. They claim they can go from an initial AI design to a candidate validated in the wet lab in maybe 6 weeks. That's incredibly fast compared to traditional methods that take years.
Okay, but that speed, it runs right into a potential wall, doesn't it? Regulating.
Well, exactly. You connect this to the market opportunity, generative AI in drug discovery. It's forecast to grow like crazy, something like 27.4% CAGR. Huge potential. But the major threat is regulatory uncertainty. The FDA, they're still figuring out how to handle these adaptive AI models. It's complex, the whole black box issue. How exactly did the AI design this drug?
Right. Can you really validate it if you don't fully understand the AI's process?
Precisely. So if regulators demand really long, unexpected validation studies, specifically because it's AI designed, well, that just blows up Absci's whole speed advantage.
Yeah.
And makes their cash burn problem even worse.
A critical risk. Okay, let's talk about the team trying to navigate this. Chapter 2, Management Evaluation. The CEO, Sean McClain, he's the founder, started young, aged 22. That often means vision, speed, maybe less experience with the hard realities of pharma development.
It's a valid point, the founder risk idea. But Absci seems to have actively addressed this. They've brought in some serious industry heavyweights. Take their chief innovation officer, Dr. Andreas Busch. This guy previously headed R&D at giants like Sanofi and Bayer. He's been involved in developing over 10 drugs that actually made it to market. That's real-world experience.
Okay, so deep clinical know-how layered in.
Definitely. And the board reflects that, too. You've got former senior people from tech Microsoft, Meta, presumably for the AI side,
Right.
but also biopharma veterans like a former EVP of R&D from AstraZeneca.
So a deliberate mix of tech vision and pharma reality checks.
It seems intentionally structured that way, yes, to balance the AI excitement with the tough clinical path.
Now, building all this costs money. A lot of money. They are heavy R&D spenders.
Oh, absolutely. Heavy is an understatement. For 2024, R&D expense was, what, $63.86 million, and total revenue was only $4.53 million. It just dwarfs the income.
And their capital policy is clear from the sources.
Yeah, no dividends, no share buybacks. Every cent is plowed back into growth, into developing that platform.
Which inevitably leads to the return on invested capital,
Right.
the ROIC. It looks bad on paper, right? Deeply negative. How should listeners interpret that? Is it just failure?
It looks bad if you expect short-term profits.
Yeah.
The reported ROIC, yeah, it's like negative 47%, deeply negative. But for a company at this stage, it's almost mathematically required. That negative number doesn't necessarily signal bad management. It quantifies the massive upfront investment they're making.
Right.
They're sacrificing any hope of near-term return to build this platform they believe will generate huge returns later. It's the cost of building that future.
Right. Context is key there. It's an investment, not necessarily a loss in the traditional sense yet. Chapter 3, Financial Analysis.
Okay, shifting gears to the financials, we see this interesting contrast. Massive losses, but also some underlying strength.
The losses are significant, aren't they? What's the cash burn situation look like?
Yeah, profitability is just not there. Consistent net losses, over $100 million in each of the last 3 fiscal years. Free cash flow is way in the red. It's very much a cash-burning operation. They rely heavily on getting more funding, whether it's partnerships or eventually selling more equity.
But you mentioned underlying strength, despite burning cash.
Yes, and this is their saving grace, financially speaking, for now. Their balance sheet looks pretty robust, very little debt. The debt-to-equity ratio is low, around 0.19. And crucially, their current ratio, which measures if they can pay their short-term bills, is really strong at 4.67.
Okay.
So the bottom line is, yes, they're burning cash quickly, but they have a decent cushion of liquid assets and minimal debt. They have runway.
That makes sense. Now, valuation, this is tricky. With those losses, the usual PE ratio is meaningless. So how do you even value a company like this, running mostly on hope and potential?
You have to look elsewhere. Price to book, PD ratio, is maybe more informative here. It's around 3.6x. That suggests investors are paying a premium, about 3.6 times the value of their net assets. What you're really paying for there are the intangibles.
Yeah.
The technology, the AI models, the IP.
Right, the potential value of the platform itself.
Exactly. But the metric that really screams story stock is the price to sales, PS ratio. It's incredibly high, around 157 times.
157x price to sales. Wow.
Yeah. To justify that kind of multiple, the market isn't just expecting growth. It's basically pricing Absci today as if they're definitely going to develop and license a blockbuster drug, maybe several, really soon.
So it's a huge leap of faith baked into the current price, all based on the platform delivering big time.
Entirely on future potential, pretty much ignoring today's actual revenue.
Chapter 4, Market Sentiment, which brings us right back to where we started, that deep split in how the market sees that potential.
Absolutely. You've got the bulls totally focused on that massive upside. The analysts are overwhelmingly saying strong buy. Average price target is hovering around $8 to $8.30. They believe the tech will win out.
They're buying the story.
They are. But then you have the bears, represented by that huge short interest, that 21-23%. They represent serious, sophisticated money actively betting against that story.
And what's their focus? Why bet against it?
They're looking squarely at the immediate problems. The huge cash burn, the historically high failure rate for any drug in early trials, and the very real threat of more shareholder dilution down the road when Absci inevitably needs more cash.
Makes sense. But technically, looking at the charts, momentum seems to be with the bulls lately.
It does, despite the shorts. The stock's a longer-term uptrend. It's trading well above its 200-day moving average price is $4.40. Average is around $3.63. Plus, the recent news has been mostly positive. Things like accelerating the ABS 201 trial, new tech partnerships with AMD and Oracle, that's likely helping support the price.
So the narrative and the recent trend are positive, even with that big short position looming. Interesting tension. Chapter 5. Ownership structure. What about who actually owns the stock? Institutional ownership is high, right? 67%.
Yeah, it's highly concentrated among institutions. Fidelity is the biggest name holder mentioned in the sources.
But the sources also mention mixed activity among these big players, some buying, some selling.
That's right. And that mix kind of confirms how tricky this stock is to time, even for the pros. You see Vanguard and BlackRock adding to their positions, maybe signaling long-term belief in the platform. But then ARK Investment Management, known for betting on disruptive tech, actually reduced their stake recently. Perhaps concerns about the near term, the valuation, or just portfolio rebalancing, it shows the debate is happening inside the big firms too.
Okay, but there's one ownership data point that really stands out as a counter-argument to the bears, isn't there? Insider confidence.
Absolutely. This is probably the most compelling point against the short thesis from an ownership perspective. Insiders hold a decent chunk themselves, maybe 6 to 9.25%. The CEO alone owns almost 6%.
And they're not just holding, they're buying.
Crucially, yes. The sources highlight multiple recent open market purchases by key insiders. People like Director Manny Pongalos, the Chief Accounting Officer Todd Bedrick, and the Chief Innovation Officer Dr. Bush himself. These aren't stock options. This is them putting their own money on the line, buying shares at current prices. That's a powerful signal. These are the people who know the most about the platform's progress, and they're betting on success. It directly challenges that big short interest.
A strong internal vote of confidence, definitely something for listeners to weigh. Chapter 6, risk assessment. Okay, let's dedicate a section to really summarizing the risks. We've touched on them, but let's consolidate. Starting with those internal weaknesses the short sellers are likely focused on.
Right. The short thesis isn't pulled out of thin air. It's based on real challenges. First, the high, ongoing cash burn. Second, the partnership revenue can be lumpy and unpredictable. Third, the pipeline is still very early stage. Statistically, drugs at this stage have a very high chance of failing in trials.
And that need for cash leads to
The continued need for funding, which often means selling more stock shareholder dilution. That's a constant overhang.
Okay, those are internal. What about external threats? We mentioned clinical trial failure as the biggest, obviously. What else? Macroeconomics. Do high interest rates really matter here?
They absolutely do. High interest rates make borrowing money more expensive, obviously. But more importantly, for a company like Absci, they increase the discount rate investors use to value future earnings. Biotech is the classic long-duration asset. The big payoff is potentially years away. So when interest rates rise, the present value of those distant future profits gets suppressed. It hits pre-profit companies harder.
And inflation.
Inflation just adds to the pressure, increases operating costs, lab supplies, salaries, which means their cash burn rate goes up even faster, accelerates the timeline until they need more funding.
We also can't ignore geopolitics, can we? U.S.-China tensions, for example.
Right. Why does that matter? Supply chain? If trade tensions or tariffs disrupt the flow of key materials, maybe active pharmaceutical ingredients, APIs needed for research or eventual production, that drives up R&D costs. Again, it hits the cash burn, accelerates the need for dilution. It can also cause delays in development if they can't get critical supplies. It's another layer of external risk.
Chapter 7, conclusion.
All right, let's try to synthesize all this. Absci seems defined by this stark contrast, this dichotomy.
Yeah.
What's the core bull case boil down to?
The bull case hinges on that unique tech platform, especially the data engine, that 3 trillion data points per week moat, plus the validation from big partners like Merck and that really strong signal from recent insider buying. They're basically betting on a revolution in drug discovery.
And the bear case, stripped down. It's grounded in the harsh financial reality, the heavy cash burn, the near certainty of future dilution. Combine that with the immense execution risk getting drugs through clinical trials is incredibly hard, and the market skepticism shown by that high short interest. It's a bet against pulling off that revolution anytime soon.
Our educational DCF model, trying to quantify this, gave a really wide intrinsic value range. What does that tell us about the current $4.40 price?
Yeah, the model spits out a range anywhere from about $3.50 to $7.50 per share. That huge range itself tells the story. It reflects the almost binary nature of the investment. If the platform works and they get clinical success, the value could easily be $7.50 or much higher. But setbacks in the clinic or with regulators, that could push the value right down to that $3.50 level or lower.
So the current $4.40 price is kind of in the lower middle of that potential range. What's the final takeaway for someone considering this?
An investment in ABSI today is undeniably speculative. It's a long-term bet. You're betting that their innovative platform not only works at scale, but that it overcomes those massive historical failure rates in pharma. And crucially, you're betting they can do it before they run out of cash or dilute existing shareholders into oblivion. It's a race against time and statistics.
A very clear summary of a complex picture. Now, before we wrap up, the final provocative thought for our listeners.
Okay, here it is. ABSI's ultimate future value might rest on something subtle. Can their massive data generation, those 3 trillion points a week, make their AI so predictive, so reliable, that it actually forces a change in how regulators think about drug approval? If they can statistically prove their platform designs drugs that are inherently less risky than traditional methods, well, that changes the entire game, not just for ABSI, but for the whole industry. That's the moonshot scenario.
Something definitely worth pondering. We hope this deep dive into ABSI has been valuable for you. If you found this useful, please do like and subscribe to Stock Analytics AI. For just $4.99 a month, you get immediate access to our full playlist deep dives covering all 500 stocks in the S&P 500. And coming up next, exclusively for our members, we're tackling the entire NASDAQ 100.
That's right. And members, don't forget you can request specific stock deep dives too. Just drop the ticker symbol in the comments section and we'll research it and turn the analysis around for you.
And finally, the important reminder we always give.
Please remember, this analysis was generated by an AI system using the sources provided, and it's purely for educational purposes. It is definitely not financial advice. Always do your own thorough research before making any investment decisions.